Good afternoon, everyone, and welcome to the Exemplar Growth and Income Q3 webcast. My name is Pierre Lalonde, and I will be your host for today's call. On behalf of all my colleagues at Arrow, thank you very much for joining us today. We always appreciate the opportunity. Our speaker today is Ted Whitehead, lead portfolio manager of our flagship Exemplar Growth and Income Fund. And during our time together, Ted will provide you with an overview and update on the fund's strategy, will share his thoughts on the Canadian and US markets, and also talk about how the fund will navigate Q3 and Q4 on an inflation and GDP perspective. Of course, we will save some time for a Q&A at the end of the presentation, and you should find a tab either at the top or bottom of your screen so you can enter your question. Now, we all know that last year was a tough year for everyone. In 2022, everything was negative. You couldn't hide. Every asset class were down. Exemplar Growth and Income, unfortunately, did not escape. And for the first time in our existence, we ended up negative on the year. And so far this year, we haven't made some ground back like our peers. Ted will address what happened, why, and what we have done to mitigate the situation. We are still 100% committed to our process that has served our investors so well the past 8 years, and we are very confident that the fund is well positioned to navigate the next 2 quarters. We're different than our peers, and we are still the perfect complement to anyone's portfolio. Ted is a senior portfolio manager with Arrow that brings over 30 years of experience in the financial services industry. So with that, I will thank you again for joining us today and pass it over to Ted.
Thanks, Pierre. There's the disclaimer. I guess you can read it at your leisure when you get the slides later in the mail. So as Pierre said, we're here to talk about the investment process, just a bit of a recap, the first 8 months of the year, and our outlook and the opportunities that we see. The picture there is of a bear and a fella says, "I'm going to call the Fed." And it reminds me of really that's what happened in March of this year. But anyways, we'll address that too. So as we've talked about many times before, we use the quad model from EGIF as part of our forecast. And basically in quads 1 and 2, you want to be in growth and equity exposure. And in quad 3 and 4, you want to be underweight equities and more exposed to bonds. The outlook for the fourth quarter is a mix of quad 3 and quad 4, and we'll address that in the presentation. This slide goes over the asset classes and where you'd like to be given the quads. Now, it's not hard and fast as to the, in quad 3, you have to be in all these different sectors, etc. And the other thing to keep in mind that any individual quad doesn't show up at the beginning and end of that quarter. So for example, it doesn't start July 1st and end September 30th. It sort of, it's dynamic and accumulates over the quarter. So a further breakdown of different asset classes that you can invest in the different quads. Like I say, in some cases, it worked, and in others, you have to adapt to the situation. It's not 100% foolproof that if we're in a quad 3, you want to follow that roadmap. It can vary from that. The bull and the bear, is it different this time? So we'll talk about how things evolved from the beginning of the year. I think when we did our podcast around January 10th of this year, we were looking for quad 4, where you want to be more into bonds and underweight equities. and the probability seemed to be fairly high, especially as the year went on, that probability was increasing. As you can see, in first quarter to second quarter was going up from 51% to 64%, rather than like a quad one, which was going down. But in hindsight, it turned out that both quarters were a quad one. And as we're experiencing the back half of the year, things are transitioning more to a quad 3 or 4. So one of the things that sort of took us by surprise, I suppose, is the government spending. And on the second line there, you'll see the government is spending at a deficit rate of 8% of GDP. And typically that's what they spend in recessions. Normally the deficit is around 4% in a regular year, but it was much higher so far this year. And we see in the back half of this year is that things are going to dramatically slow from the government spending side. And some people have said to me, well, because there's an election next year, is the government going to not increase spending? Well, the reason it's coming down is programs are coming off the shelf. There's a program called SNAP, which is something like a food stamp program. Medicaid is being reduced for around 28 million people. The child care benefit disappears in the fourth quarter. Other things that are coming up are student loan payments start again in October. And we're facing a couple different situations with the UAW strike and the government shutdown, which don't really affect government, or the UAW doesn't affect government spending, but it will impact where we see GDP going. And this is just the consensus from Bloomberg. And you can see from the second quarter of this year, it goes from 2.5% down to 2.1. I think estimates have been going up. So the peak will probably be this year in the third quarter for GDP. You can also see that from the Atlanta Fed in July, they were calling for 5.9 and now they're down to 4.9. But they adjust their numbers based on that as the data comes out. And the GDP forecast, or what is likely to be for the third quarter of this year, is again higher than expected, not because of government spending, but because of, believe it or not, Beyonce and Taylor Swift and Barbenheim. People have gone out and done more spending than normal. So one of the things that comes up is what about the U.S. debt level? And at the end of June, it was 32 trillion. And here we are in September, it's already at 33 trillion. And deficit forecast for next year is another 1.6. So this has been putting some pressure on the bond market of late. And actually since about April, but it's really started to impact equities come this September. And I think there will be a bit of a moment where the government will start cutting back on spending. And even as you see in the back half of the year, spending will be reduced. And even as the amount of money that has to be used to pay interest is forecast to go to 1.2 trillion next year. That's going to crimp the amount of money the U.S. government can spend on discretionary to support GDP. So the go forward is a slowdown, in our opinion. So where are we going into third quarter? It's likely to, again, turn out to be a quad one, but things have sort of started to transition or slow down around the middle of July. So even though all encompassing, the the GDP is likely to come in around 2.7 or higher, which is an acceleration from the second quarter. On a monthly basis, it's already starting to decelerate and go. So the market is behaving more like a quad 3 environment, especially since the end of June. You've seen commodities take off, where oil prices are up 40% since the end of June. So that is starting to play into what inflation is going to be in the third quarter, which is likely to be somewhere between 3.5% and 4%. So where we made it wrong this year is we expected the slowdown in the front half of the year, and it's being postponed to the back half. And normally our forecasts have been fairly accurate. Unfortunately, with government spending and non-residential construction, which is related to the Inflation Reduction Act and the CHIPS and Science Act, what was forecast to be spent between last summer and the first half of this year was $270 billion, and it turned out to be $620 billion. I don't know if you recall, but in the January of this year, when they're debating the debt ceiling, and they were on special measures to meet the payments, they said we have until August and before we have to come up with a debt ceiling agreement. And then all of a sudden, they had to get one in the first week of June. And so they brought forward a lot of that spending to boost GDP. So what happened to our performance? May and June really did all the damage. In May, the TSX was down 5% and the S&P was flat. We have been leaning more towards the Canadian market, and I can explain why a little bit later. And in June, we had was this big recovery, and the market broadened out for about four to 6 weeks. And we were not able to flip over quick enough to catch the upswing. And before you knew it, that upswing is now reversed and gone back down. So I still think we're well positioned for the back half of this year, and the quad model will prove to be correct. It's unfortunate that we missed the rally in the first half of the year, which was dominated by 7 stocks in the US and 1 in Canada, Shopify. If you didn't have any kind of weighting towards those names, you underperformed. And we had no exposure to those names because in a quad 4 environment, you tend not to want to own technology because growth comes under pressure. So you can see this is the TSX, the sector attribution to the end of August. Infotech is up 51%. Now, it wasn't just Shopify that went up, but Shopify is a big portion of the TSX. And of that 4.68% return, if you took out Shopify, that return would be 3%. So it was a big piece of the pie. And then you can see the defensive sectors, whether it's real estate or communication services or utilities, or even the staples, were not particularly great. And so we were positioned in the early part of the year for that line, or where we were in utilities, staples, and the defensive sectors. We had some exposure to energy, and we had gold. We've increased we've added uranium at the beginning of the summer, so we've had some good luck there. But the areas that really did well or outperformed were the high beta names or the unprofitable small cap names, such as the Russell or some of the growth names. We are also long the US dollar, which is what you want to be when growth is slowing down. And the US dollar in the first 6 months, it went down. And even now, it's still, the US dollar is a little bit down versus the Canadian year to date. So if we had known or suspected that a quad one was going to pan out, we would have positioned differently. It's just, this was a year where the government was a big part of the GDP, and that caught us off guard. And and also it's typical that it's more evenly spread out on the quarters rather than how you saw the big spending in the first and second quarter. So the Russell 2000, which is a small cap index in the US, around 40% of those names don't make money. You can see over the last 3 years, it's almost back to flat. And on the year-to-date basis, it's close to flat as well. So it had the big run up until about the middle of July, and then things have been selling off. And again, I think that's related to the GDP is slowing, and small caps tend not to perform well in when GDP starts to decelerate. The NASDAQ has really been the killer, which is this is the NASDAQ 100. But again, same idea. Apple has come back to its 200-day moving average today. And it looks like things, well, they've corrected from the summer. We'll have to wait and see whether the total damage has been done or whether there's more to be done in the last quarter of the year. So again, this slide just highlights the performance up until the end of August. And NASDAQ has been leading the way, S&P 500. But again, these are dominated by those 7 stocks. The Russell 2000 was up almost 8% at the end of August, and now it's near flat. The equal weight, again, I think that as of yesterday was probably down 20 beeps. So things have started to deteriorate. It's just a matter of, will the seasonality play out as it always does, which is markets tend to correct between August 15th, October 15th. So we still probably have about 2 weeks where the market could be a little choppy or uncertain. But the bonds have not been any help this year, and the currency has not been any help as well. So on to the individual stocks. Typically, as I said, we're more in the defensive at the beginning of the year for sure. And the defensive, safe, oligopolistic type of industries in Canada have done poorly, whether it's the REITs, fear there of, well, rates have gone up and then of maybe cuts in distribution. Communications companies have all gone down. The pipelines have gone down. Even Loblaws and Metro are down. The banks are down. And again, the new mantra in the markets these days is factor investing. So what these companies all have in common is they're highly leveraged, lower interest coverage because they're leveraged, and low growth. But typically, these would be classified or defined as the go-to names in a rough economic environment. But it didn't really pan out that way this year. Now that may be changing. The Bank of Canada is on hold. And so maybe this is the area where there's opportunity going out for the next 12 months. So people ask, have you changed your process or your style? I would say, no, we have not. We continue to follow the quads. It's unfortunate that growth reaccelerated in the front half of this year. And despite having a banking crisis in March, which again, this is typically what happens in a quad four when rates are rising. Like the normal condition of a quad four is rates are going down and the contraction or the correction is only around 5%. It's nothing too outrageous. But when you have these quad fours and the interest rates are rising, you tend to get these bigger corrections. So if you look at the correction in the S&P since the middle of September or July, it's already 8%. And so it could be much bigger, maybe another 5%. Maybe we're hitting support here. We'll just have to wait and see how things play out. But anyways, getting to the banking crisis in March, we suspected like there was another shoe to drop. And what happened is the Fed came and launched the bank term funding program, and the market looked at that and said that's another example of the Fed put, and fear in the market just dissipated. The VIX index, a measure of fear, went from 32 in the middle of March down to around 13 in the summer. And it's always easy in hindsight to see, that the fear index was declining, but at the time it never goes down in a straight line. It always looked like there would be more problems. And in the first week of April, we had what's the name? I want to say Frontier, but First Republic was bought by JP Morgan. And we thought maybe there'd be more after that, but there wasn't. But when JP Morgan bought First Republic, the Monday, they hedged their book that they bought, because the First Republic had monster mortgages, which are interest only, and then with a big payment at the end. And so that Monday, they hedged their book by selling the long bond. And if you look, the TLT, the ETF on that day went down over 2 points. And I think JP Morgan netted their guarantee, which was $5 billion from the Fed, by taking that. So anyways, we kind of missed the GDP acceleration, and I guess the hype from AI also played into the optimism or confidence that the market got. But we try to play probabilities, and based on what we had, we knew that we thought the probabilities of quad four were high, and even though it didn't occur exactly in the first quarter, that it would occur in the second. And even though earnings declined by over 4% year over year in a rising GDP environment, it goes to show you that earnings on the wholesome scale doesn't really matter. Earnings matter individually to a stock, but it's the GDP, whether it's accelerating or decelerating, that tends to get people confidence in the marketplace. So inflation, recession, what's coming our way? So we just had our call with EGIF this morning, and the way they see it is earnings are going to, or GDP is going to continue to decelerate out into next year. And I would say that maybe that's what we believe. But if you happen to get like a 10 or 15% correction between now and the end of the year, or whenever that occurs, that will be the buying opportunity. The deceleration will be priced in. And that may be what's occurring now. We're starting to get, as we say, we're going through a correction. It's already 8%. If there's another 5 to 7%, at the end of that, if that all happens in October, that's likely pricing in a lot of this negativity or deceleration. And on inflation, they have it hovering between 3.20 and 3.5. Their updated version this morning is more or less around 3.5. It doesn't really accelerate, more or less plateaus. And part of that is due to commodities and the lagging effects of wages. And so what you're seeing is people getting wage increases now after the fact that inflation has already come. So based on the forecast, we're looking for either disinflation or stagflation. We'll look for signposts in the market. At the moment, it's definitely stagflation with oil prices up 40% and other commodities up. That's a sure indication that we have more of a stagflationary environment than disinflation. So we've had this inversion, which in the 2s and 10s, which peaked March 8th and again in July. When a recession occurs, it's usually as the inversion disinverts or goes back to zero. And so when I did this slide on September 20th, the negative inversion was 78, and now we're less than 50. It's, I think, 48 this morning. And so the fact that that is going back towards zero is another indication that a recession is more likely, or that slowdown is coming. So this is a slide from Schwab, and that based on the jobless claims that have come out, it still is pointing that a recession is possible or on the way. And one of the outfits that we rely on is Piper Sandler. And based on their information, that there'll be adjustments in October, which will start to show jobless claims going up. Even though today the jobless claims are out there quite low at around 204 or 201, they are expected to start going up in the fourth quarter just due to seasonality effects. And why does unemployment matter? It's the market tends to go down as unemployment is going from the low to the high, and then the market tends to go up as unemployment is going from the high to the low. So let's say we were at 3.5% unemployment, and we've already seen that tick up to 3.8. And if that happens to say it peaks out at 4.5, then that's during that rise in unemployment that the market is likely to go down. On the sentiment side, from the consumer, it's fairly poor. It's back to the COVID levels and the great financial crisis levels. And a lot of it has to do with the inability, or people are making less than they were before COVID. So on this slide, again, this is provided by Wolf Research. Prior to COVID, the wage growth was meaningful in the sense that you ended up getting more than what the running inflation was. Whereas since COVID, the wage growth has about kept pace or a little behind what the inflation has been. So people are losing their purchasing power. Another thing on the consumer is they've exhausted their savings. Apparently, the lower 80% are now negative, and the top 20% still have some savings left. And when GDP 70% comes from consumer spending, I think it's going to be tough going forward for the consumer to help GDP along. And then we already talked about the GDP growth from the government spending. So it looks like going into the winter, it's going to be rough as to where growth is going to come from. Again, outlining the difference between the different markets with just the top 7 names. They're up around 66%. So if you had a 10% weighting to that group, you're up to 6.6%. It made a huge difference. And unfortunately for us, that wasn't where we were. Again, because technology typically does not do well in a quad 4 environment. And we are just positioned incorrectly. And on the S&P 500, a lot of those names make up a big portion of that. And then on the remaining 493, they're barely up 5%. So I think in the weekly, I sent out a piece from Carter Worth showing 47% of the names are down since last October, and 53% of the names are up. So it hasn't been a broad-based recovery since the bottom last October. And it hasn't been equally dispersed as well, like a very small, heavily weighted group in the index contributed to a lot of the gains. Financial conditions have been loose, but they have been tightening. As you can see, that last little hookup since the bottom in summer is what's impacting the market. Like, these financial conditions have a big impact, and it doesn't take much to go above that dash line to choke things off. And I think that's what's been going on of late, with bond yields going up. So we still believe there is a quad 4 or a reaction function in the market that will be like a quad 4. It's just a matter of timing. And in reality, we are experiencing some of that right now. The last 8 weeks or so have been more of a quad 4 environment mixed in with a quad 3. Where do we see opportunities today, or what are we going to talk about? Gold, oil, the equity market, US dollar, and bonds. So on gold, what I'm highlighting here is the real yields. Last time in October of 2012 and August of 2020, gold hit highs, and this was when yields were negative, I don't know, around 1.5%. Today they're around a positive 2%, and gold actually hit 2050 and 2065 in April and May of this year. And we were thinking that gold was holding up pretty well, considering real yields are plus 2%. Then the last 2 days, gold has kind of given up the ghost. But I think what gold is kind of sniffing out is that real yields are likely to come down. And I think you will get the gold going back up. Or at least that's what maybe the next slide shows. This is a chart from graph by All Star Charts, highlighting the gold futures. And it's a big cup and handle. So even where gold is right now, it's just coming back into the handle part. My advice is, if you want to buy gold, is to wait till you get a closing of $2,000 on gold. And then the likelihood is that from there, gold will go up 15, 20, maybe 25%. The pros, that's what they're looking for, is a monthly close of 2,000. So we have around 3.8% in gold and some gold stocks, but we typically hold between 3 and 5%. And then when we're bullish on gold, we own 10 to 15%. So we're just holding it as a bit of a hedge for the US dollar at the moment. On oil, this is what leads us to believe we're in the stagflation environment. Is oil has broken out, and there's a number of reasons why this is going on, and whether it's the Russians or Saudi Arabia cutting back, or some other OPEC members having difficulty ramping up their production, oil prices have been going up. And what prevented or held back oil prices in 2022 was the release of reserves from the Strategic Petroleum Reserve. And now that that's down 40% from where it used to be when Biden came in, there's not really much left that they could do to help ease the pain of oil prices. So it is now more market forces. The only thing that would cure high oil prices is high oil prices where demand actually cuts back. So other things that are driving it up, European gasoline consumption hit a 10-year high this summer. So it had been going down and is now starting to go up. And I think part of that reason is they're getting more people in from through migration. And if you're coming from a poor country and maybe had no car, and now you get access to a car, there's more people and more people consuming more of the commodity. As I mentioned on the other slide, Strategic Petroleum Reserve is down 40% under Biden, so there's no room to really keep releasing more. Total OPEC production is down 7 million barrels a day since November of 2016. So there has been quite a bit of a cutback there. And there hasn't really been a lot of new discoveries or money being put into the ground. And the savior in the 10 or 15 years ago was the evolution of shale, and that is pretty much past its prime. And a lot of people near that don't like the shale drilling. And so the other thing, the energy companies themselves have refocused on shareholder returns through dividends, buybacks, and debt repayment. And I think all that comes back to, if you think to May of 2020, oil went to negative 35, negative $36 a barrel. After seeing that, energy companies said, no mas, no more of that. We're going to focus on making money. And so I think it'll be hard to get energy companies to go back and just, as Larry Kudlow used to say, drill, baby, drill. It's all about making a return and not just quantity, not just production. So the slide above doesn't really refer to oil, but it refers to be, I guess, a rich country. You need to have cheap electricity. And to be a rich country, people use more electricity. And so I use this more for our investment in uranium, where I think that will become more prevalent in the years ahead. As China is going that way, and I think other countries will begin to go back to using uranium because it's more reliable than the wind and solar. So anyways, these are other sectors in the market that did well in the first half of the year: semiconductors, home builders, industrials, technology. And they've hit their high of that they hit in 2022. And then they've pulled back. For this market to resume and hit new highs, I think these are 4 sectors that would have to lead. So these are things that you might want to track to see where the market's going, because I see this group as the leadership. They're like the phoenixes that came out of the dust, and they've risen, but now they've hit some roadblock. We'll see if they're able to regain that momentum. And that's the other thing, like energy as well. Like I talked about it the oil prices went down to minus $35. I think that's a sector that's in more of a secular rise. And sure, you'll get periods where oil can come back, what's around 93 today or 92 or 91. It can come back maybe into the low 80s, but it's likely that that is going to be on a trajectory upwards. And again, I would say that about technology is here, is that well, you can get the correction, but for the long term, this is a sector that has secular staying power. Now, again, that doesn't mean these things can't correct 15 or 20%, but I think these are the two sectors for sure that are going to lead the next bull market. So where are we in the year? This would typically be a pre-election cycle. Next year is the election year, and normally you get sideways corrective phase September and October, and then things rally into the year end. We'll have to see. We have seen, like in 2018, although that wasn't an election year, is that December does not always have to be a good month. So we'll just have to monitor, see how things go. It could be that the market is bottoming today and we're off to the races, but we'll see. So how do you know when you get to a bottom? Well, there's a technical indicator called the McClellan Advanced Decline Summation Index. And at the time when I put this out on September 8th, it was at 901. And as of yesterday, it was negative 50. And typically, once you get into negative 1,000 to negative 3,000, is time when you want to start accumulating equities, because the selling exhaustion starts to hit. So that's something we'll be watching for in the coming days. The US dollar, it's been going up for the last 10 weeks. This is usually not good for risk assets. And again, that's what's been happening to the equity market. It's been going down ever since the US dollar has been going up. So again, we're monitoring this. We're long US dollars. It's been a difficult slog, I would say, because it went down in the first half of the year, but it's been going up since mid-July. And we kind of think it's going to go much higher, because the US has room to have their interest rates go higher relative to Europe, which is in a recession already. And Japan doesn't seem to be too eager to defend their currency. And the UK is in recession as well, or at least on the verge. So on the 10-year yields, at the time when I put this together on September 8th, yields were only 426, and today they're around 464. But you can see it's getting up near the top end of the channel. It's likely to do a pullback at that point. One of the chartists that we use, Carter Worth, is expecting at least a check back to the 420 area. So hopefully that happens. That'd be good for the markets and good for bonds. And it does indicate that really bond yields have not broken out according to this channel, which goes back to 1980s. Other technicians would say maybe that it has, but again, we're watching this. We think yields here at around 464 are probably getting a little tired. And if you look at the tilt index, or the TLT, which is the 20+ year bond, it's done terrible. For the last 3 years, it's down about 45, 46%. And so it's been going on for 3 years. That would be the longest correction or bear market in bond history. Now, yields were really low, so maybe it does make sense, but we are back to levels last seen in 2008. And there are large short positions in the bond market, which will have to be covered at some point. Short positions always means there will be buyers at some point. 10-year treasury yields, you can see that at the beginning of the year, bond yields went down in January, so bonds had a positive performance, and then in the early part of March, they rallied again, and that was on the banking crisis. But ever since then, yields have been straight up. And again, I think whether it's the debt has been going up consistently, or in the thought of inflation coming back, we're monitoring to see how this plays out. But I would suspect there's some sort of bond rally between now and the end of the year. So what do we expect? 10% plus correction in the equities. We're almost there. So I think there'll be an opportunity. And where I see the opportunity is more in the Canadian market. Despite the fact that we've already had one negative quarter of GDP growth, which was the second quarter, I think we raised rates first. So we're going into the slowdown or slowing down faster first. If the Bank of Canada doesn't raise rates and allows our dollar to go down versus the US, our export companies should do better. So there's a certain group of stocks which I think will do better, and that's what we'll be looking to focus on. If it's more of a recession, then we probably want to have just less equities. But we are running a low equity book at the moment. With stagflation, that would definitely favor Canada over the US, because we have more material names. We do expect employment to begin to roll over. Areas of market, we do like bonds. We think, as we pointed out, that bond yields are probably extended here, and there could be a rally. Energy, I think, is in more of a secular bull market. Is there a pullback if we get in a recession? For sure. Gold, I think its time will come when real yields start to back off again, and maybe they go negative, but I don't think they need to go negative. And for the moment, while there's this uncertainty, I think US dollars are the preferred currency. And while in Canada, if we are going to have another negative GDP quarter, definitely US dollars should be the place to be. So I know we've had a rough go kind of in this year, but there is a songwriter who wrote a song in the 60s, and a couple lines from it are, the loser now will later be win, and the times they are changing. And that's Bob Dylan. And I feel that's the way where it is for us. Is sure, we missed the easy money, the run up in the tech giants, but the backdrop is changing and it will be more difficult. So we think our time will come, and we'll be able to put up some good performance.
Very nice. Thank you very much, Ted. So let's jump right into the Q&A. Let me open the queue. I think I saw a few questions coming through. My glasses on. One of the many questions we received, I'll go with this one. Where did the fund lose money last year? Equities versus fixed income? Was it something else?
So last year it was bonds, and the fact that two things went up. Energy stocks went up, and the US dollar and gold was flat. So I guess we just didn't have enough US dollars and energy to make a difference. But this year, unfortunately, because it costs money to hedge or protect portfolio, and that's cost us more than we would have thought. But it's around 3% that we've spent in trying to hedge and protect for a downswing, which really didn't materialize. We would get periods, and then it would vanish. And I would say the biggest mistake so far this year was when the banking crisis happened. I expected that this was more of the beginning of something worse, and really everyone else or the market thought the Fed took care of everything in a weekend with the bank term funding program, and there's been no issues. But what I would say to that is, since the banking crisis, the Fed funds have gone up 100 basis points, and assets at banks are either bonds or mortgages, and the value of those things have gone down. So I think there's still a problem with the regional banks. And sorry to continue on, and then to talk about the Canadian banks, I think 40% of the mortgages are now negative amortization mortgages, meaning you take a mortgage for $300,000 and it renews in 5 years, that mortgage will be $325,000. Because the banks don't want to own the house. They'd rather at least the person pay, but that mortgage is growing. And I just think, well, what if house prices are down 10% in 3 years? Or, that's assuming rates, like it makes some big assumptions. It reminds me of when I went to school, like everyone would participate in gym and you'd get this participation. Whereas, if you ran a race, you would define who was the winner, first, second, and third. And here now, everyone is allowed to participate, like what they call extend and pretend. The market is not, doesn't seem to be a clearing mechanism anymore. And I would say that's an issue. Sorry.
Okay, Ted. An interesting one here. What are your thoughts on money supply? There's been contraction, meaning less money to pay for things that are more expensive. What are your views on the money supply today?
Yeah, so the money supply has been coming down. And they say it's the first time it's negative since like the 1930s. But we also had a fairly big injection. So that's just working that off. I'd say it's better, at least from a stock market perspective, to watch the financial conditions index. And again, it's not necessarily a level, it's the change. So as you saw on that graph, it started to change and hook up. And it didn't matter that it was below a certain level, it was that it was now tightening again. So that might be a better thing to watch.
We have a few more questions, but we've passed our time too. So what we'll do, we'll pass those questions to Ted and we'll make sure to email you back on your questions. So what I would like to do at this point is, first of all, thank you, Ted, for your presentation. We really appreciate it. And thanks everyone for joining us on the call today. We always appreciate the opportunity to be with you. So thank you for that. And in summary, what we would like for you to take away today is that Arrow is still 100% committed to our process. It has worked very well for our investors since our inception in 2015. It hasn't been that great last year and so far this year, but as Ted highlighted during his presentation, we have made some adjustment to our process to make it more adaptable to outside intervention, like the government and central banks did last year and again this year. What do I mean by interventions? Well, I found this interesting slide from EGIF, and it explains it very well. I hope you can all see it on your screen, but let me read it. Basically, what it says is, once upon a time, the American people trusted the founders to act in the nation's best interest and tell the truth. After the events of the past week, that responsibility turned fuzzy sentiment. Feels like it's from a galaxy far, far away. Basically, Jerome Powell has repeatedly claimed his ultimate goal is to bring inflation down to 2%. Last week, the FOMC's decision to pause an interest rate hikes proved the Fed's real priority. Really, it's pleasing Wall Street elite is their number one priority. Months ago, the Fed chair said September's interest rate decision would be based strictly on data. Then, after every economic indicator pointed to another rate hike, Powell threw the data out the window and decided to stand pat. That decision was not in the best interest of every American, but because it was for the top 0.1% of the country that begged him to do so. So this is an example that we mean by intervention by the government and its central bank. And this can have a really effect on our process, the economic cycles, and the markets. We are convinced that the adjustment we've made to our process will bring back the long-term track record that you have been accustomed to see from exemplary growth and income. And we have started to see some result in the last 3 months. As Ted mentioned, we see a very high probability that Q4 will be in a quad 4, and we are positioned accordingly, ready to protect your clients' money. Our process is different than all our peers. We believe a 15-20% or more allocation to our clients' money, of your clients' money in Exemplar, is like adding an insurance policy to their portfolios because we are different than everything else they own. So this brings us to the end of our webcast. And again, thank you for joining us on the call today. Please do not hesitate to reach out to your Aero sales team if you have any more questions. Have a safe rest of the day. Thank you.